Good morning, good afternoon, good evening, everyone. I am Alex from Sharpe Two, although many might know me under the name Xander. That's how I write on Substack. This is a quick rundown of the Sharpe Two platform. We have had a lot of newcomers lately. So first of all, warm welcome. Welcome to the platform. Welcome to the site. I hope you will find it useful. This is one of our most requested video, and I am quite excited about it. So without further ado, let's just dive in. When you log into the platform, the data you see here are updated once a day. You can always check the timestamp at the bottom here. So for instance, here you see that the data from yesterday, the 27th at the close, were updated around midnight East New York time. So the SVRP page is the most important one, especially if you are beginning with options and focusing on harvesting the variance risk premium. You will find other source of edges like long short signals and some specific vol surface dislocation. You need to be a little bit more comfortable with some of the concept, especially around delta neutral, vega neutral. We'll talk about them in another video. But first, let's rewind a little bit and let's ask ourselves, what is the variance risk premium? Well, it is all about setting implied volatility and measuring it against realized volatility. So really you have these two columns here, implied and realized volatility, and that gives you an idea of what the VRP is, although to me this column here is your North Star, and we'll see in a second why I do think so. But for now, let's start with implied volatility. So for instance, you can see here that you can sell about 47 implied volatility in USO right now. This is the expectation of what volatility over the next 30 days in the product is going to be. Realized volatility, on the other hand, is the reality. It describes your cost center. If implied volatility is the premium you collect, realized volatility is the claim you will have to pay over the lifespan of the option. So the main problem with it is it's backward looking. We can't know the future, and in particular, if the market will move a lot, we can only estimate it afterwards once it's done. You can obviously forecast it, but you have no idea if the premium you've collected through implied volatility, so that 47 here, will exceed your cost ultimately, which is realized volatility. Again, if we stick to that analogy of a car insurance, for instance, you can sell insurance to a group of customers called USO and collect about 47 in premium. All you know at that stage is that last month, the average claim you had to pay back for that group was about 27. The difference between the two is what you receive basically is what we call the variance risk premium. If you sell at 47 right now and realize 35 over the next 30 days, right, the lifespan of the option, your P&L is going to be 10 points of volatility. And ultimately, this is what we mean by harvesting the variance risk premium. But you start to understand the use case. It would be really nice to know in advance the probability to know if the premium we sell right now, so that 47, is likely to exceed the subsequent realized volatility. So now that we know the basic, let's look at a North Star. To me, if you ask me, this column right here is the most important one on the table and probably in the platform. This really tells you if you have an edge or not. And if we take that specific example, USO right now, it basically tells you you have some strong chance of harvesting premium. So how do we read this? Right now, you can see a short signal with 77% probability. This essentially means there is 77% chance that implied volatility you sell today, so that 47, will exceed realized volatility over the life of the option. So it's a very strong signal to be on the short side of volatility and harvest that premium. Short because you will consider structures that sells options like straddle or strangle, for instance. But at that stage, you might ask yourself, how did we get to that probability, right? So it's not a black box. We run machine learning models in the background. They use common features in the volatility space, like the current level of implied volatility, obviously, the realized volatility, the different term structure, volatility of volatility. And you can see ultimately how they come up to that decision. That helps to build a trust, but also intuition, especially if you are at the beginning of your option journey. and you are trying to understand how you can come up with good trades. For that, you can simply dive into the analysis section where you will find the key drivers regarding the different prediction, but also other type of visualization. So this one is actually quite interesting because it helps you see over time how the probability to harvest that VRP has changed over time. And we can see right now that it's been pretty high for a few weeks, and that makes sense. It's in line with the new geopolitical development between US and Iran. We'll talk about that maybe in another video. But as it is right now, that 77% chance to harvest that premium is very strong because the machine learning model is essentially pointing to the fact that the z-score is well above 2.7 almost. You have more than 20 points of premium. So again, the difference between realized and volatility and between implied and realized volatility, excuse me. Any trader would tell you this is an extreme situation. Now, maybe for good reason. Once again, keep Iran in the back of your mind. But as it is, that situation is well described by that super straight z-score, and the 20 point of premium should leave enough room to make money while selling implied and waiting to see how the market actually moves or realize that volatility. And essentially, in such market condition, you look at the term structure here, for instance, you would potentially need a catastrophic movement for realized volatility to exceed what you are selling right now. And hence the reason why the probability is so strong. Now, doesn't mean you want to sell it anywhere, right? Once again, that term structure can be quite useful. We make prediction at 30 days, but also 9 days. So you could consider that this is if you were selling an option that expire overall in 9 days, and this is if you were selling an option that expire overall in 30 days. At Sharpe Two, we tend to focus more on 30 days than 9 days. 9 days, you have to assume more gamma risk. And in a situation like USO right now, you can have a violent reaction almost overnight if there is a missile somewhere or some hitting up on the headlines. And we definitely would avoid those short options. So we understand better what harvesting the variance risk premium mean, right? It is essentially selling implied volatility without knowing in advance what the average claim over the next 30 days will be. We only know what it was over the last 30 days, so 27 in that case. We can rely on our North Star to tell us if there is high chance to see implied volatility sold today exceed realized over the life of the option. So again, if we take another example, in silver right now, you could sell 103 in terms of implied volatility. You only know that over the last 30 days, realized volatility was about 73%. That's almost 30 points of premium. That's great. That's a great description to know. What our models are basically saying is you have about 74% chance to see that number exceed the subsequent realized volatility over the next 30 days. So once again, that column here, extremely important, the most important column, if you ask me, in the platform. But as you can see, we have other type of probabilities designed to help you understand the different market dynamics, really. So we have prediction in all of those different columns, and we will see pretty much what they mean. So, for instance, for implied volatility and realized volatility, we make a prediction about the direction, but not about the magnitude, right? So right now in USO, for instance, we're saying there is a pretty decent chance to see implied volatility going down over the next few days, few weeks. And we're saying there's a pretty decent chance to keep seeing realized volatility going up over the next few days, weeks. Usually we make predictions up to 2 weeks. Once again, I insist on this. It's about the direction and not the magnitude. For instance, in ULG, so nat gas, for instance, it's not because you see 90% chance probability to see realize going up that we expect that number to go from 67 to 85 or 100, for instance. we predict the direction, but not the magnitude. So if over the next week or so you see 68, that probability would be considered right. So here is another column that we haven't talked too much about. It's the volatility of volatility. So same idea. You have a prediction that helps you understand what the direction of vol is going to be over the next few days and few weeks. Vol is often overlooked, and I think it's in the retail community, but it's extremely important. Basically, when it's high, you shouldn't be surprised to see VIX move 4 or 5 points intraday. So, for instance, everybody understand that if VIX is at 16, 17, usually it means that nothing is happening in the market. But if you have high level of vol, you shouldn't be surprised to see it go to 21, 22 in a couple of hours. If you don't have a high level of vol in the market, it's less likely to happen. So this column is quite important, again, from a market dynamic perspective, because it helps you to understand the risk you take by selling implied volatility and see it run against you and therefore hurting your P&L. And then there is the skew. This helps you decide if you should lean towards puts or calls. If the skew is expected to steepen, puts should be higher in demand. And if it is expected to flatten, like here in an XPI, it means that the demand for put is expected to fade. Once again, this helps you structure your trades. We tend to be delta neutral, but sometimes when the skew is extremely steep, maybe you just want to sell the put side, or maybe you want to sell a little bit more on the put side. Ultimately, this helps you decide which side you want to be. Do you want to be short option and do you want to be long options? All of those other columns help you to understand the dynamic, the market dynamic, what to expect over the next few days, over the next few weeks, and give you an idea of how you're supposed to be designing your structure. Ultimately, the platform is designed to help you save time. The best short signal are always going to pop up at the top of this table. Shouldn't come as a surprise that these days, obviously USO is at the top, Boyle is at the top because of the storm happening in the US and the cold up until state like Texas and the southern part of the US. Silver, obviously, the precious metal sector is under extreme stress at the moment. And ultimately, the platform is also designed to help you move from descriptive analytics. So we do have a lot of charts. There are other parts of the platform where you can see those charts, especially here in the dashboard and volatility surface. In the analysis section, you always find these charts. You can potentially change as well and see the one that you want to see. But those charts are great to describe what's happening right now in the market. They're not always good to tell you what's expected to happen over the next few weeks or so. And ultimately, we help you transition from descriptive analytics to predictive analytics. And you will see this with all different prediction that hopefully you will find useful. It's not just at 30 days. Once again, it's also at 9 days. Keeping in mind, again, 9 days, you're much more exposed to gamma risk, and that's something you want to take into consideration. It doesn't mean you cannot put a trade in there. Just be aware of your risk, especially when you have special situation like what we observe at the moment in silver or in USO. We do generate, for those that like to read, a little bit of text in here that can help put the different key drivers in perspective. And that's pretty much it for the analysis section and for that VRP page. There is one last column that we need to talk about. It's the regime column. So context is everything in trading, and one of the cardinal rule is trade the regime you're in, not the one you may eventually see. You will see tickers that are essentially flagged under different regimes. So right now, considering the market condition, all of them are under stress. But essentially, we have a clustering algorithm here that will do its best to label all those different tickers using the different volatility data that describe what's happening for all of them. And same data as before, right? So implied volatility, realized volatility, the different term structure. So you take silver, for instance, it's flagged under extreme stress, and that kind of makes sense. Like you had a crazy reversals, 10% drop in a couple of hours on Monday night, if I remember well. So in extreme stress, the moves are irrational, and you probably want to sit out anyway. You don't necessarily see them here, but the best regime to harvest the volatility premium, it's going to be calm, positive VRP. This is normal market condition where implied volatility is structurally above realized, and it is much easier to harvest the variance risk premium here. In stress, you can still do it, right? You just need to manage your risk a little bit tighter and closer to your chest, or consider other type of hedges, especially vol dislocations, when you can do calendar spreads or skew swap. Obviously, you need to start considering and be more comfortable with delta neutral and vega neutral at the same time. But usually, when you see and positive VRP, you don't need to think too much about it. The math tend to work in your favor. So to wrap up the VRP section here, especially that column, that is your North Star. It gives you the probability that selling volatility will be profitable. Check the regime, that's useful. Check all the different predictions to get an understanding of the different market dynamics. And then once you want to dive deeper into something, you can get into the analysis section to decide if the signal matches your own view of the market. And then once you're done, you can add it into your watch list like this. That's always useful to revisit some of the trades and some of the signals that you've been watching, and decide if there is something to do. You can potentially build an alert against one of those signals. I'll do other videos to explain all of those concepts. And in the meantime, if you have questions, please leave comments under the video or join us in the Discord, contact me on Substack. In any case, thanks for watching, and I speak to you soon.